business, and things to be mindful of as you start out, so that you don't have any foot faults early on, and that you're protected, and that you're well on the road to actually running the business and not getting bogged down with some of this administrative stuff. Quickly, the agenda, just going to cover some initial steps, things to be mindful of as you start out on your path of starting your business and running your business. Marissa is going to cover the pros and cons of various business or tax structures, more so tax structures. We get that question a lot, and you'll see there's several different options for you. There's a couple other things we'll hit that are important, and then we'll open it up to questions. So the first thing, as you get started to do your business, is the drafting of a business plan. This, I will say more often than, well, I shouldn't say more often than not, but it's something that a lot of small businesses or get rolling, or someone by themselves starting a sole proprietorship, they may not think this is important, may not do it, but it's important. It's, aside from maybe needing it later for financing, a good business plan, it's going to kind of give you the steps of how you want to run your business, how you want your business to be managed. And there's, a couple of different, I guess we'll call them traditional versus lean, or the typical ones we see. They're kind of self-explanatory. Traditional, we'll get into that in a second, has a little more detail to it. Lean, obviously, is very high level of what that structure is going to look like. So again, just a quick examples. Lean, less common. You're going to focus on the key things, probably product, what your company is, and what your plan is. It's going to be very basic, not a ton of information, maybe bullet pointed. A traditional plan, this is going to be a little more detailed, and a lot of times this comes into play because you're expecting to need funding, and that funding could either be through a normal lending institution. It could be that you're going to go out and look for outside investors that are not tied to any banking. But if you think you might need that, it's good to get this done up front. And then, this is typically what you would hand out to those investors to say, hey, here's my plan. This is how I intend to make money. This is how I intend to run my business. And this is why I'm a good business to lend to. So key elements of a traditional plan, obviously company description, what that company is going to include, your name, what your company is going to do. I'll skip market analysis for a second. Organization management, how that your business is going to be organized. Is it going to be you and a partner, you and 2 or 3 partners, you and a key employee, what your service is going to be, what your product is going to be, how you intend to market it, and that ties into your market analysis. With that, the market analysis is a lot of times it's what's my location, what's my demographics in that location for the service or the product, is there a market for it where I plan to open up that location, and then the marketing ties into that, right? How do I plan to market to that demographic so that I can maximize my profits and have a successful business? And those are all the types of things that anyone who's want to invest is going to want to see. And I think, Kevin, you've got experience dealing with these as well.
Yep, I was just going to say a couple of things to add in there. So one of the things when it comes to organization and management, and I used to write SBA loans when I used to work for a bank earlier on in my career. Even if you're buying into an old business, an existing profitable, successful business, a lot of times if you're a new owner, SBA or whomever's looking for that lending is going to look for a business plan. One of the things that the banks will look for to hinder their risk is if you're keeping someone in that organization who has experience, especially successful experience in that business. So something we'll see often is, let's say that you're buying ABC company. What you might do is have that owner stay on for a year or 2. So that way, when you are going for new plan or new funding or whatever it might be, it makes the banks and those institutions a little bit more comfortable to lend you that money. The other thing too is there's a lot of different resources out on the internet as far as creating these types of business plans. I mean, you can actually see some out there. You can get templates for them. You can find different opportunities. So if you are working with something, if there's a specific goal in mind, keep that in line when you're writing that business plan to better understand that. So it's just 2 parts. Even if it's an existing business, it's still a good idea to update that business plan if there's an ownership change or if you're trying to buy. And then having that person on there with experience. If you're going into a whole new business that you don't have experience, it doesn't matter how profitable it was in the past. Banks really like to see that there's someone with experience helping you out and point that business in the right direction, who understands that industry. Thanks, Rich.
Yep, I appreciate it. All good comments. Next comment here, so legal representation. Early on, this may or may not require a lot of attorney time, but it's always good to at least have an attorney that you've reached out to, that you plan on using either early on to help with, Kevin mentioned you can find these business plans, and that's probably the best place to go early on. But if you get into a spot where you think you want some assistance or you want someone to take a look at it, they can assist with that. Business entity, we'll talk a little bit about this, but they can, assist with what type of structure, probably from a legal standpoint, LLC, how we want that to be structured, from an asset protection standpoint. Anytime you go in and you have a business entity structure that's outside of just a sole proprietor, you start getting into the LLC or the S Corp context, and we'll talk about more of those later. You're going to have organizational documents that you're going to want to have in place. Attorneys can help with those. They can definitely help with business registrations. Depending on your industry, those could be, very, very simple, or those could be very complex, or there could be quite a few of them. And then, if you're going into a special industry, food and beverage or something like that, it's always good if you're seeking legal counsel to try to find, someone who might have some familiarity within the industry. I say all of this with the attorney stuff. A lot of this stuff early on, you may be able to take care of yourself. Some people are a lot more comfortable doing that. They feel like they can go through a lot of these steps themselves, dot the I's, cross the T's. Others like to go through it, but have an attorney there to take a quick look at it, make sure they're not missing anything. And then some, want complete attorney involvement. How you choose to involve them is up to you. Obviously, the cost is gonna vary depending on how you do that. But I do always think it's good to at least have reached out and at least have someone in mind that you will use should the need arise.
One thing I'll add there, Rich, too, is it's always nice to have any sort of handshake agreements or verbal agreements reviewed with an attorney. What might be a handshake agreement, that's fine in the beginning. In my career, I've seen it a lot where once, people see numbers on a paper, all of a sudden they forget what that handshake agreement was. So in the beginning, where it might be, hey, it's trust, it's just the two of us or three of us starting this business. Down the road, it can be very important to have those agreements in place when you start talking about the impacts on people's families, livelihoods, and what they'll be able to recoup from that business in a life-altering event.
Yeah, that's a great point. Next slide. I'm biased to this one since I'm a CPA, but having a good CPA on board early is also important, just as important in my opinion as an attorney. Aside from, that being able to assist with the business plan and how you want to get any funding, they can also work with your attorney or with you on the entity structure, specifically from the tax standpoint of it. What that, they can work with you on what your goals are, or what, how that structure is going to impact you now, what type of flexibility that'll give you from a tax perspective later on. And it's good to have them on board, a good CPA on board early on when you're working through that structure, before you get that set up. Same thing on the organizational documents. Like Kevin said, you got handshake agreements. You may have handshake agreements that have, some type of impact from a business standpoint, while the tax aspects could be different. So it's good to understand, how do we want to run this organization? How do we want to set up this business from a financial standpoint? But then, what does that look like for us if it's partners or whatever? What does that look like from a tax perspective? And what type of impact could that have on us later on if for whatever reason we need to go our separate ways? And then this one is, I'll say this last one, advise on the proper setup of books and records. In most of the small businesses I see that come in and we end up working with, this is an area where I think they fall down the most. Is they get going and they set up their LLC or whatever, they start running their business, and they don't really think about how they want to do their books and records. They don't think about how they want to account for things, and then all of a sudden they get caught up running the business, and 4 months in, they've got maybe cash in the bank, but they don't really know, you're paying bills, you're doing all this, but they don't really have a set of books or what their financial picture is starting to look like. And if that goes too far down the road, now you're spending a bunch of money for someone to come in and help you clean that up and make sure, your cash is what it's supposed to be, your books are what they're supposed to be. So that's for me, that's a big one because we see it a lot.
Another reason that professional advisement's good, and it's also considering the relationship. Again, going back to my banking days, I have a lot of business owners who would go to their accountant and say, make it so I pay the least amount of taxes. But then they'd be coming in and looking for a loan for their business or to fund some equipment, and we'd be turning them down for a loan. Main issue being that they might be clearing a reasonable amount of money, but in that goal of trying to avoid paying for taxes, it's not showing as much on the books because they're trying to write off everything that they possibly can. So it's good to have that professional advisement too, to kind of guide you down that middle of the path of, here's a safe way of avoiding or preventing some tax liabilities, but also making sure that when someone comes and asks for your numbers, they're still going to look good to be able to get you that loan down the road or keep growing your business.
Yep. Business structure. So we talked a little bit about this. Marissa is going to cover some pros and cons of these later, but I'll just hit them quick now. Sole proprietor, that's, a lot of businesses start out that way. It's really just, I open up a business, I start running it. No formal legal entity. It's just, my name or whatever you want to call it, running the business. It's reported right on your personal tax return. LLC is actually a legal entity that can either be right on your personal tax return, or it can be taxed as a partnership, or you can make an election to be an S corp. We'll talk about it later, but that's a separate legal entity, provides some asset protection. Obviously a step above a sole proprietorship from a asset protection standpoint. Partnership can be an LLC with a couple partners, or it can be a formal limited or general partnership. Again, that's more asset protection than the sole proprietor. And then S and C corps are just two different types of corporations. That's where you get into incorporating the entity, corporate structure, corporate governance. S corp is just a pass-through entity where the income's taxed to you on your personal return. A C corp is self-contained, probably has the most asset protection out of all of these because it's self-contained within that legal entity. Nothing really filters out to you personally other than you might be collecting a paycheck from the company. Banking relationship, this is another one early on that is good to get going. Another football I see with this a lot, especially with a sole proprietor starting out, is they start running the business. They figure, I got to get this, I got to buy these supplies, I got to get this equipment, and they run off and they put some money aside to do this personally, and they just start spending it out of a personal bank account, or they have a personal credit card, and they figure I'll use my personal credit card, I'll pay it as the money comes in, and they start commingling, personal and business assets. And, the further you go down that path, now when someone does come in to do the accounting for the business, they've got to peel all that out. We've got to go through bank statements, what's personal, what's business. If you're ever audited for that period, it becomes a kind of a pain in the neck, because now it's like, how do you got to go back and prove something, that was personal, is personal or not business, and vice versa. So another really great step early on is go set up a bank account, go get a credit card, get it in the business name. Whether you're using it a lot early on or not, you usually can get some commercial, and Kevin will probably be able to speak to this better than I, having been in the banking, but you usually will be able to get some favorable accounts with not a lot of fees, not big issues. Get that set up, and then that way when you get rolling with the business, you're doing it right. Everything from day one is in that business's name. You don't have any issues with commingling of anything. The other part is it gets you a banking relationship with a financial institution that the business is in. A lot of them are going to require an account anyways. If you need funding, you've already got it. When you go in to do funding, you've got that relationship established already.
Yeah, Rich nailed it on the head there. Having a relationship with a bank is also going to make them more willing to lend to you over time. They're going to see what your deposits are. They're going to see what your transactions are. One thing and I don't know if it's changed, it has been close to a decade since I was in an actual bank. go from bank to bank, because each bank has really unique or quirky rules when it comes to business accounts. If you're a cash heavy business, there's branches out there who are going to charge you for cash deposits where a credit union may or may not. One bank might, charge you a fee because your balance isn't high enough, where another one might not. So it is worth picking up that phone, talking to a couple bankers, and finding out which bank is going to support your business the best. You really don't want to get started off with a business and having a bunch of fees for your a banking relationship. It should be something that you can find at no cost just by shopping around and looking at different institutions that are out there. Also, never pay for an EIN. It's a 5-minute process. It's one of the few things I think that the federal government does right. So if anyone offers to for a fee to go and get you an EIN or a tax ID number for your business, tell them thankfully no, and just give me a call and I'll walk you through the 3-minute process for doing it at no cost. Actually, the cost is 1 beer if you ever see me out at a bar. I changed my mind.
Yeah, Kevin's right. It is. We'll hit it briefly later, but getting an EIN is you do it. You can do it online. You can do it over the phone with the EIN. It takes 2 seconds, and I've had a lot of clients say, "I need help. I don't know how to do this. Can you just go and give?" I said, "I can, but this is the easier way to do it." And to Kevin's point about shopping around, same thing with your attorneys and your CPAs. Although I happen to be biased and think we do the best job, but when you're meeting with attorneys, you're going to get referrals from people. Meet with a couple attorneys, meet with a couple CPAs. Ask if they serve clients in your industry, things like that.
Last
so
thing, sorry, I'm going to cut you off. Right, I was just going to say, it just popped in my last thing to add on there. Especially when it comes to the attorneys, to understand what their background is. If you're going into a business that could have a lot of liabilities or stuff for you, make sure you have an attorney that's worked in that area before, who understands the nuances of it. It's not always, getting what you paid for. It's making sure that person has the expertise that's really going to help suit you, not just that they can handle the work, but that they can provide some value added above and beyond just creating your business documents or providing some advice.
So business registrations, we kind of hit on this a little bit. I've kind of split them out, federal and state, local. Of the 4 bullets here, the only one that a lot of people will ever need is the first one, which is the EIN. And like we talked about already, I won't beat a dead horse here, but that's easy to get over the phone or online. Very, very simple. The other is trademark protection. If you're in a situation where you have something that needs to be protected, you'd file that with the government. If you're starting a business that needs or intends to be a not-for-profit, that's an election or you need to apply for with the federal government. And then if you're a business entity, an LLC, or some other structure that chooses to be you want to be an S corporation, that's another election that gets filed with the federal government. But for most purposes, there's not a lot of registrations required with the federal government. And tax ID, again, easy to get. You're going to want this if you intend to pay anybody, you intend to collect any type of revenue, file employment taxes, do business with other business organizations. They're going to want that for tax reporting. So it's important you get an EIN. And again, like Kevin said, don't pay for it. It's very easy. Your CPA, or you probably could Google it. It's very, very simple. State is a little more involved in terms of what you need to register for and how you need to register. This can be where an attorney could be helpful or a CPA could be helpful. Which states do you need to register in? It depends where you plan on doing business. Obviously, where you're gonna open up or where you've formed your business, and that's that domestic versus foreign. That's not foreign as in international. It's whatever state I incorporate or organize my business in. If that's New York, that's my domestic state for state purposes. If I were planning to do business in Pennsylvania and I needed to register, I would register as a foreign corporation in Pennsylvania because I'm foreign to their jurisdiction because I was incorporated or I was formed in New York. One of the things with these registrations, I run into this a lot, is clients will form themselves in either New York or an easy to form state like Delaware because it's easy to change entity structure there. and then they'll go start doing business in multiple states, and they do not register in any of those states. And then either later on, they have to do something for sales tax, they haven't registered, they're not able to do it, becomes a real headache. But the larger issue is that most of the states will tell you, if you don't register to do business in their state, even if you're not collecting payroll, you're not doing sales tax, if you don't just have a general business registration, the way their rules work is they'll tell you if a lawsuit or something legal should arise, technically you're not allowed to use their court system. So if you had a customer in that state that brought some type of lawsuit against you, you could have an issue, you haven't registered in the state. It's able to be worked around, but it becomes a little bit of a headache and it could be costly. So, I always say register in those states. If it requires you to have to file a tax return and it's a zero return, it's really not that expensive to do that. You can do a lot of these registrations yourself. You can hire what's called a registered agent, which is just, there's a bunch of them out there. They basically become your agent in the state, if you will, and they just handle your registrations and any annual filings that come up. There's obviously a fee associated with that. I suspect most people starting out are going to be contained within one state, but I mention this because quickly people go and they start selling across state lines, and then this piece of it gets away from them. And then 2, 3, 4 years down the road, all of a sudden they get some notification from a state, like, hey, where's your tax return, or where's your, we noticed you're selling to this customer and not collecting sales tax. So, the minute you start crossing state lines, it's always a good idea to register.
Rich, do you have any advice? Say you're a online retailer, you're offering your product online. One client orders it in Alaska. Do I need to go run out and register, or is it once you get some traction, or any advice, guidance there?
Yeah, it gets a little bit, you start getting with the online stuff, it gets a little bit hairy. Most of the states, more states are moving towards asserting some type of sales tax when you're selling online once you reach over a certain threshold of sales. So there's no set answer, I guess, is the answer to that. If you have a couple sales into a state that is just online, you're not physically delivering into that state, you're probably okay. Once you start having a decent amount of volume within a state, then it's probably time to think about start registering. And you really got to, and this is where a CPA comes in, you really got to look at what the sales tax rules are in those states, even more than income tax, because the sales tax rules are much, much stricter in terms of when you need to start potentially collecting sales tax. So it's a good point. And that's why I always say the minute I have a client who starts crossing state lines, you need to start looking at, all right, do I need to register? Do I need to register for sales tax? Do I need to file a tax return? What do I need to do here? And I think we've educated our clients enough that most of the time they'll call us and say, before they even have a sale, I've got a potential customer in Texas. This is what, it's 1 or 2 sales now, but it could be bigger later. Before I sell this, what do I need to do? And that's a good practice.
Thank you.
Got it. Again, cost to register, it's typically pretty low. There's usually an annual fee associated with it. You file an annual report. A lot of times it's just listing any updates to officers or shareholders. I won't read through this slide, but this is the typical information you would need in order to register. And again, a registered agent can help with this. I don't think you need an attorney to help, but they can help with this. So payroll and sales tax, this is, Kevin mentioned it a second ago. We talked a little bit about it. When you register to do business in a state, you can register for each of these things. Sometimes you may not know if you're going to have them early on. A sole proprietor, you may not know if you're going to ever hire somebody. It may just be you for a little bit. You may not know, or you may be selling something that you don't believe is subject to sales tax, so you don't register for this. If you don't know and you decide I'm going to register to do business, I'm not going to register for either one of these things, you can go back and register for them later. So it's not like, all right, I can never have employees, I can never sell products that are taxable. The flip side of that is if you register for payroll, you register for sales tax within a state, most states are then going to require a return whether you have taxes due or not. It's a zero return, obviously, but they'll require a return because you've registered and said, hey, as of this date, I'm going to be registering to collect and remit payroll taxes, collect and remit sales taxes. So they're going to expect a return. And I mention that because what happens is sometimes people register and they say, yeah, eventually I'm going to have payroll, I'm going to have sales tax. They mark those, they register, they go out doing their business, they never file returns, and then all of a sudden they start getting notices, which, while they don't necessarily owe tax, the notices will say that they do because they'll come up with some estimated number. I've seen New York do that, say, all right, well, you never filed your sales tax returns, you owe $1,000 each quarter. You don't really owe it, but now you got to have somebody, either you got to deal with it or you got to hire a CPA or have your CPA spend time dealing with the fact that you didn't file, so now you got to get filed, but you also got to get the tax waived or prove that you didn't owe it. So just be mindful of that when you register. If you do mark those, that you should, be mindful of the filing dates, whether it's quarterly or annually, and just remit that zero return that shows you don't owe it if you don't owe it. Funding your business. So, Kevin will probably be able to jump in on some of this with his banking experience, but, some of you may or may not need funding from outside sources. You may be able to do it yourself, but, kind of listed 3 sources here. Self-funded is self-explanatory. Then you got investors and loans. We'll talk about these on the next slide, but this is, as we talked about earlier, when you're talking about a business plan, if you go to an investor or you're going to get a loan, this is where having that traditional, more complex, more detailed business plan can really be helpful. So you're not just walking into a bank with some, pie in the sky idea of product or service. You got something laid out, you got some type of market analysis, and just, you become a more creditable lender or borrower at that point. So again, self-funded. Go ahead, Kevin.
Oh, I was just going to say, the other thing to pay attention when you're looking at your different fundings for a business is what it'll do to your liquidity and cash flow. You might have the capability to self-fund something. Might be a new piece of machinery or equipment for your business, but it might leave you cash strapped for payroll, or it might make your balance sheet or cash flow not look as good if you're going for lending down the road. So one of the things we work with a lot with our clients is the balance between making sure you have enough cash and cash flow on hand, while still using, I'm going to refer to it as other people's money, lending investors for some of those other business things. It's not always a bad thing to have a cost or a loan in your business to make sure that you're not cash strapped down the road.
Yeah, that's a great point, because we run into a lot of clients who are very adverse to carrying debt, and there's a lot of times where, depending on the type of debt and the type of product, it may not be a terrible idea to have that there, provided it doesn't impact anything in terms of other lending that they may need to do, or any type of borrowing. Contractors sometimes get worried about that, but it depends on the loans. Not having any loans, may or may not be a good thing. So, but running through these real quick, it's pretty self-explanatory. It's self-funded. It's your personal assets. Maybe you have cash, maybe you have family or friends who, are not necessarily going to be your typical type of investors, but are going to give you some personal loans. Some people leverage their 401k. Kevin probably does not like that. Investors, this is the realm outside of the bank, right? This is maybe it's a friend of yours who's going to loan into the business, or it's another entity that likes what your business plan, and maybe they have either a similar or a product that's can tie in with it, and so they want to invest in your business. The one thing with that type of investor that you usually will give up is some level of control, right? So if they're going to invest in your business, depending on the amount of that investment, they're going to want a certain amount of ownership back, so that they have some type of A, control, and B, mechanism to get that money back out of it, right? They're investing obviously for a payoff. So the downside to that investor, that second one there, is you're probably going to give up some level of control of the company. Maybe not total control, but you're not going to be the 100% owner when you go that route. Loans, that's what we were talking about a little bit with the banks. That's your I go down to a lending institution or a bank and I get a loan. Usually there's a lot of products around for startups. And, you know, there's similar to what we talked about earlier, shopping around. You want to shop around for the banks for the loan products as well. The good thing about this type of debt is you're not going to have to give up any type of ownership. If I go to a bank and get debt, it's just debt on my balance sheet. It's not, I'm not having to give them 10, 20, 25% of my company for that loan. I just carry the debt and I pay it off through the operations of the business.
Just one thing on the investor piece too, you know, you can always turn to Aunt Jody and Uncle Tom for some money. They might hand you $5,000 or $10,000. You don't really need to have a business plan. They're trusting in you because they know you, their family, their friends. But as businesses grow, you can still do investor funding. We have a lot of, you know, larger private equity or private placements here in the city, Syracuse, where, you know, that business plan is so detailed that it's saying if you invest, you know, $50,000 with us, this is the cash flow we expect to generate for you. This is when we expect to get your principal back. And this is, you know, the A, B, C, D round of funding. So depending on what type of investors or what type of funding you're going for is also going to dictate how much information or how much that investor wants to see from you to trust you with their money.
Yep, again, getting back to why that business plan early on is important. So we talked about this, or I talked about this a little bit early on, but just to hit it again, you know, your accounting and financial reporting, as you get started, you know, there's a lot of different ways you can do this, but identifying how you want to handle it early on is important. I would say what I see most is this first one here. Most of our businesses starting out decide they're going to try to do it themselves. They get QuickBooks. Oftentimes they get a QuickBook version that's not as detailed as what they need. So they get the cheapest QuickBook version they can find. Then they find out it doesn't really do some of the things they want, so they try to force it to do that. But you know, that's usually the first route, and you know, that's a better step than doing nothing. You know, figuring out how you want to account for everything. The other option, you know, obviously you could outsource it day one. Probably the more costly option, probably not what you want to do right away, but you know, we have a whole group here, Client Accounting Services. That's what they do every day. They're essentially the outsourced bookkeeper or CFO for a lot of our businesses, or a lot of our clients here, who, you know, either, you know, don't have the capacity to hire a full-time bookkeeper. They just want someone to review their stuff quarterly or monthly and make sure the books are squared away. So they'll use us. So that's another option. You know, and as I say at the bottom here, there's really no wrong answer early on. Just important that you get some type of plan in place and that you've got some mechanism to account for your you know, income and expenses, and that you're tracking it. Ideally not in Excel, ideally in some form of software, be it QuickBooks or something else. And then, you know, I'll mention here too, the other thing, if you're doing nothing else as a business owner early on, review your bank statements, your cash. You know, I would say review it weekly, but depending on how many transactions you have, but review that, because that's at least going to give you an idea of the ins and the outs from a cash perspective, and clue you into anything that's out of whack early on before it gets recorded into any type of accounting system. Just reviewing that cash rec, doing your cash rec from the bank can save you a lot of headaches later on. So with that, those are some of the, you know, things we talk about early on. We talked about business structure, business types. Marissa is going to now take over. She's going to walk through kind of pros and cons of each of them. I'll try to jump in here and there, but she's pretty good. She'll have this covered for you. But this just gives you an idea of each entity, you know, why people choose it, and then what are the negatives and why they might go with something else. So Marissa, you're up.
Thanks, Rich. So choosing the correct business structure is a pretty important step when you're starting a business. Your business structure affects how much you pay in taxes, your ability to raise money, the paperwork you need to file, and your personal liability. On the next few slides, we're going to discuss the pros and cons of the most common business structures. There are others, but these are the ones we generally see. So to start out, we have sole proprietorships. Sole proprietorships are, like Rich said before, one of the most common ones. You're automatically considered a sole proprietorship if you don't register as any other kind of business, making them the easiest business to form. As a sole proprietor, you are the sole owner of that business, which means you're free to make all of the business decisions and you have control over the company. You are also able to register the business in the trade name, which provides protection at the state level to prevent anyone else in the state from operating under the same name. Additionally, because the business activity is reported on your personal return, there is no requirement to file a separate business tax return. On the flip side of those, sole proprietorship provides no asset protection, which is one of the biggest downfalls of this business entity. The asset protection is important because if you don't have that, then your personal assets and your personal liabilities could be at risk if someone brings a lawsuit against your business. Additionally, because you cannot sell stock of the company because there isn't any, and banks tend to be a little more hesitant to lend money to sole proprietors, it can be harder to raise capital. And the administrative burden can be greater if you decide to change your business structure down the road. Because you have to file for an EIN, you may need to re-register under that new EIN with your state registrations, which can create more administrative burden. So generally speaking, sole proprietors can be a good choice for low-risk businesses and owners who want to test their business idea before forming a more formal one. Next up, we have limited liability companies.
Yeah, and just real quick on the sole proprietor, that's typically your one, we see it's a Schedule C on someone's tax return, and, typically not a lot of income early on, and like Marissa said, you're just starting out, trying to get, see what type of traction you may get, because if it doesn't work out, to shut it down, it's pretty easy to just stop doing business. So that's why that one's pretty common early on.
Next up, we have limited liability companies. These are called LLCs in our world. The LLC lets you take advantage of the benefits of a corporation and a partnership business structure, so it's kind of like the best of both worlds. A major benefit of LLCs and the rest of the business structures we're going to talk about is that you have personal liability protection. So the LLC protects you from personal liability in most cases, meaning your personal assets like your car, your house, your bank accounts will not be at risk if your LLC or the company files for bankruptcy or faces a lawsuit, which is a huge benefit. Because the income is passed through to and taxed on the owner's tax return, you can avoid the potential higher tax rate and the double taxation associated with corporations, which we're going to talk a little bit more about later. And another advantage of an LLC is that it's flexible on the number of owners you can have. So if you wanted to start out today with just you, in the future, you wanted to add multiple business partners, you can do that relatively easily. One of the downsides of an LLC is that income is subject to self-employment tax because the owner does not pay themselves a wage. Instead, they must pay the employer portion and the employee portion of payroll taxes, which is calculated on their personal return. So with that being said, if there's more than one business owner, the business is required to file a separate tax return. So each owner's share of the income and expenses for the year gets passed through to them and will be taxed on their personal return, which is subject to self-employment tax. However, if there's only one owner, there's no requirement to file a separate business return, and all the income and expenses are reported directly on your personal return under Schedule C. So LLCs can be a good choice for medium to high-risk businesses, owners with significant assets they'd want to protect, and owners who want to pay a lower tax rate than if they were a corporation.
Yeah, and we see this one a ton with the LLCs. we have clients who a lot of times will buy real estate, and we always advise them to, even if you're buying real estate, you're just renting it out, a house or something, it's always good to at least get an LLC, put it in the LLC, provide some level of protection. Never a great idea, especially with a rental, to own it directly. And then on the self-employment tax, like Marissa said, you pay the employer and the employee portion on your personal tax return, which I think is like 15.3%. You do get a deduction on your return for half of that. So at the end of the day, you net out, you're paying, your share of it. But LLCs, there usually becomes a tipping point, and we can talk about it a little when we get to S corps, where depending on the amount of revenue you're running through that, where it makes a little bit more sense to flip to an S corp, just to save yourself some of that self-employment tax.
Thanks, Rich. Next up, we have partnerships. Similar to LLCs, partnership provide each partner with protection from debts against the partnership, as well as actions of the other partners. Because there must be multiple partners in a partnership, you will be able to share in the expenses and capital expenditures needed to run the business, which can provide substantial savings compared to if you were trying to operate the business by yourself. Similarly, if you have a business partner, it means you are sharing in the labor, which may allow the business to pursue more opportunities than if you were doing it by yourself. However, the downside is that you have to have two people or at least two people in the partnership. So you can no longer have complete control over the company and the decisions. You're also required to file a separate business tax return. So each partner's share of the income and expenses for the year gets passed through to them, and then will be taxed on their personal tax returns. Anything to add, Rich?
No, nothing really. I mean, when you have an LLC with two partners in a partnership, a lot of times when you're doing the tax return or the tax implications, you don't really notice a difference because it operates similarly, even though they technically are, if you form a limited partnership, it technically is a different entity. But, outside of that, no, you have the same potentially self-employment tax deal with this, depending on the income. But, partnerships and LLCs, they do afford quite a bit of flexibility in terms of taking on new owners and new investors, a little bit more so than an S corp, which we'll talk about in a minute.
So for S corps or S corporations, we call them S corps. They're a special type of corporation that's designed to avoid the double taxation drawback of a regular C corporation. Again, we're going to discuss that on the next slide. A major advantage of an S corp is that it provides owners limited liability protection. Again, this means the owner's personal assets are shielded from claims of the business creditors. So those claims can arise from contracts or litigation. Another benefit of an S corp is that the owners of the S corp are considered employees and are required to pay themselves a wage through payroll, which is likely how you're most familiar with being paid if this will be your first business experience. In addition to earning a wage, you also may be able to take tax-free distributions out of the company, which is another benefit of S corps and partnerships. Because the income is being passed through to the owner's personal return, again, you get to avoid the higher tax rate of a corporation, as well as the double taxation that occurs in a C corp. Another benefit that's not on this slide, but I just wanted to point out, is that unlike partnerships, one person can own an S corp, and adding another partner or shareholder is relatively easy if you decide to bring someone on in the future. Some of the downsides are that there are more administrative burdens associated with being an S corp. This includes the need to file an S election, which Rich touched on earlier a little bit. In order to be considered an S corporation in the eyes of the IRS and New York State, you must file an election statement. And there are two separate forms, one for the IRS and one for New York, that have to be filed. Additionally, the IRS has issued specific rules for who can own an S corporation. If you fail to meet these requirements, the IRS will terminate your S status and you will either be taxed under C Corp rules or partnership tax rules. The IRS also has strict rules regarding the number of owners allowed for an S corporation. And finally, you are required to file a separate business tax return. So the income and expenses for the year get passed through to the owners, and then it is taxed on the owner's tax return.
Yeah, so S corps, I'll say, are probably one of the more popular entities that we see for a lot of the positives Marissa mentioned. You know, I talked about the LLC has a self-employment tax. You know, there's no set dollar amount, but we generally tell people once you start netting about 150, 200 grand of income through an LLC or a Schedule C, you may want to think about an S corp. And the reason for that is you're paying self-employment tax on that amount, and so you start going up, you're going to pay self-employment tax on every single dollar at an LLC. Whereas with an S corp, while you're required to draw a salary out of an S corp, you can usually, I say limit, but you give yourself a reasonable salary, and maybe it's not the 150, maybe it's 75,000, and then every dollar of income over that, while it's subject to income tax rates, you save yourself a little bit on the employment tax side of things, and then that income you can take out as tax-free distributions because you're paying tax on it. So that's really one of the attractions of the S corp, is being able to do that. You know, the downsides of the S corp to an LLC is it's, as Marissa mentioned, it's a little more restrictive in terms of number of owners. You know, small business, you're not worried about it, but an S corp can only have 100 or fewer owners. You can only have one class of stock, so if you're out trying to raise capital later on, it's a little bit tougher with an S corp, because it's not like you could issue a second class of stock, because now you become a C corp. So there's more restrictions on it, but from tax advantages, depending on, you know, the level of income you're generating, it can be a little bit more tax advantageous than an LLC.
Thanks, Rich. So finally, we come to C corporations. These offer the strongest liability protection because the business is an entirely separate entity from the owners, which makes it a huge benefit. Additionally, owners of C corporations can also be employees of the business, but they are not required to be, which would allow them to receive a wage. Because C corps and the owners are completely separate, if the owner decides to sell his or her share of the corporation, the company can continue doing business relatively undisturbed. Some of the negatives of a C corp are that compared to all the other business structures we've discussed, C corps require the most upfront costs to start the business. Corporations also require more extensive record keeping, operational processes, and reporting, which again can add significant costs. Again, similar to the other entities we just discussed, C corps are required to file a separate tax return. However, unlike the other business structures we've talked about, all of the income and expenses for the year do not get passed through to the owners. Instead, all of the income will be taxed inside the business, which leads us to our final point of double taxation. As stated above, all the income of the business is taxed inside the business, which means if this corporation decides to pay a distribution or dividend to its owner, this dividend will be paid out using the same income that was already taxed inside the business. But the owner who receives the distribution will also be taxed on that income. So it's pretty costly to pull cash out of the business, which is one of its biggest downfalls.
Yeah, and one of the things we saw, I guess it was in 18, whenever the TCJA came out, was they lowered the C corp rate to 20, I think it was 20%, 21% for federal. And so we had a lot of our clients who were S corps who were paying, maybe paying tax on their S corp income at, say, 35%, because that's the bracket they were in. You know, immediately were, well, I want to be a C corp. I want to be a C corp. I'm going to pay tax at 21%. I save money. what they forgot about was this second layer of taxation, because, you know, what you had to talk to them about was, well, you know, is your intent to draw, you know, a big salary out of the C Corp, because you're going to still pay tax on that. And then, you know, how are you going to get the money out of the C Corp? Like, well, I'll do distributions like I did with the S Corp. Like I said, okay, great. You're going to pay tax at 21%. You're going to do a distribution. Now you're going to pay tax at whatever, you know, dividend rate that is. Let's say it's 20, and now you're paying tax at 41% on the same income. If you just stayed in S Corp, maybe you were at 37. So what seemed like a no-brainer because of this double taxation really wasn't. So that is why in the small business context, you don't see a lot of C corporations, because a lot of the owners like to be able to draw the money out of it when they start to build up cash out of that business, and S Corp allows them to do that in a little more tax efficient manner. So that's why, you know, when you start talking small business, don't see a ton of C Corps. And then our final slide, this is just, we've kind of talked about the structures just so everyone has an idea of, you know, what you're looking at with these. You know, a sole proprietor, like we talked about, there's no separate legal entity. There's no separate tax filing. You file your normal personal return. You report that income. You know, if it's a business on a Schedule C, if it's some type of rental property or real estate, it's going to be through a Schedule E. The LLC, this one depends. If you form an LLC and you're the only one that owns it, then, you know, there's no separate filing. It'll operate similar to a sole proprietorship. If you've got more than one owner, then it defaults to partnership tax treatment. You file a 1065. That 1065 kicks off a Schedule K-1, which gives you the income to report on your return. The one thing I'll say that I've seen here with the LLCs too is in New York, because it's not a community property state, I've seen taxpayers do an LLC. They're going to do real estate. They buy a house, it's their husband and wife, and they own an LLC 50-50, and they don't think they have any other requirement to file. That technically is a partnership. They're treated as two separate owners, you know, even though they're married. So I've seen that where, you know, not a big deal. You just have to file the 1065. Partnership, again, we just talked about it. You file a 1065. It gives you a schedule to put on your return. S Corp, very similar concept. Just file a different form. It's an 1120S that gives you a Schedule K-1, which has all your share of the income and expenses to put on your return. And then a C Corp, like we talked about, there's really no additional filings. Everything's self-contained within that. Nothing for you to do on the personal side of things. You file a tax return for the C Corp, pay the tax there. Everything's contained within it, and that's all there is for that one. So with that, I think we did pretty good on time. We are through our presentation, so I have not been checking the chat, Amanda, so I don't know if there's questions on there or how we want to handle it, but
no questions in the chat yet.
Okay, so we're through our slides, and that's all we got.
Well, I want to give a huge thank you to you, Kevin, Marissa, and Rich for presenting all this amazing information with us. And also thank you to, go ahead.
Question.
Yes.
Brian, you'll want to form the LLC first. When you do go register for your EIN, they'll ask what the entity name is. So heaven forbid you try to go and file for an LLC or something and that name's already taken, or you have to change it. So you'll want to have that done. And then once you have those basics, you can go for the EIN. Sorry, Amanda.
Oh, you're totally fine. And if there's any more questions, feel free to drop them in the chat. And if not, if you'd like to follow up privately, you can email Chelsea, and her email is in the chat as well. And you can also set up a time with her to discuss further any questions you have about setting up your own small business or any of these. Sorry, I just completely blanked out. Sorry. Yeah, any questions that you have, you can email Chelsea. And lastly, please be on the lookout for our next month's webinar. We're going to have Dennis Ast, my apologies, from One Group presenting on February 21st at 2:00, and he'll be presenting on cyber insurance. So with that, I thank everybody for attending. We appreciate you joining us for this first webinar. And if there's any remaining questions, we'd be happy to take them.
Thank you, everyone, for your time this afternoon.
Thank you. Have a great afternoon, everyone.
Thank you.